Well, welcome back to Simply Money. Tonight, we're going to be talking about SCHD and whether or not it's the ultimate index fund ETF to own. We're going to be looking at its upcoming reconstitution, dividends, and some hypothetical portfolio options. We'll also touch on kind of what's been happening. The market's been very volatile lately, and how SCHD has withstood or is faring compared to like the S&P 500 and the Dow Jones in general. So as we kind of get into that tonight, that's be some of the stuff we'll be talking about. As you come on, feel free to just throw in the chat where you're from, state or country. Say hello to everybody, and if you have any questions, as always, ask those throughout the content here. I'm be glad to interact. That's our whole point, is to discuss and kind of get everyone else's opinion and get some topics that are of interest to others as well. So, ETFs are exchange traded funds for those that don't know. And I always like to touch on what I'll call some of the basics. Never want to assume everybody obviously isn't at the same stage of investing. For those who are more seasoned, who, some of the terms and stuff you're very familiar with, I look at it as an opportunity. Share your information, share your wealth of knowledge with others in the community. Don't just feel like, oh, I'm out of here. I already know all this. And share things with me as well. I'd be glad to learn some things from those of you that have been doing this longer, who maybe have a better understanding of certain aspects, and we can share with one another as we go along. So an ETF is just an exchange traded fund. It acts more like a stock in the sense that it's traded daily throughout the day, where a mutual fund, you kind of get the update at the end of the day. So you have could be the same stocks within both an ETF and a mutual fund. In a mutual fund, you're going to get an opening price, you're going to get an end of day price. Where an ETF, it's traded throughout the day like a stock. It might drop down and go back up. So there's daily volatility in that. Mutual fund kind of has the same thing. You just don't see it. It's at the end of the day, however those stocks fared, the makeup of the mutual fund. You have, let's say, 100 stocks, and in that mutual fund, and if they're all up, then at the end of the day, the mutual fund will be up. If they're mixed, depending on the weighting of the mutual fund, they may be down or up. And then obviously, if they're all down at the end of the day, your mutual fund will be down. Where the ETF, you're kind of watching it throughout the day. It's like watching, Apple throughout the day. It goes up and down. It might go up, 2%, and it might go down 1%. And it can be very volatile, moment by moment. It reacts to news. You can see something, hit the news, and then all of a sudden you can watch the stock market, certain stocks go up or down. Let's just say there was, a new law passed against drilling oil. Hot topic. Not talking politics here, just using as an example of news and what can change things. You might see oil stocks going up or down based on that news, and that happens throughout with different sectors change in overall. And we've been seeing that. If you watch the stock market at all over the last month, especially the last week, you have a lot of uncertainty drives volatility in the stock market. That is why there's a lot of up and down. People investing don't like uncertainty. They want to know kind of what the plan is, and the forecast and the outcome. They want to know there's a strong job market. They want to know there's a strong lower interest and lower inflation rates. And so those things drive a positive note, which will drive markets up. When there's uncertainty in all of those, like if the Fed chair comes in and says, we plan on making 4 cuts to the interest rates this year, you'll see stocks go up off that news. If he comes on and says, we plan on increasing the interest rates over the next year, maybe 4 times, you'll see the stock drop just right then instantly off that news. And so you see a lot of that happening right now. There's just a lot of uncertainty. People don't know. And we're going to look at SCHD and see how it's compared and performed in this kind of tumultuous time right now. And I'm not saying tumultuous in a way like, oh, it's panic. This is, in some stocks, just use like the S&P 500, we've hit correction. Correction is when it's dropped 10% from its recent high. And I think over the last month, you don't quote me on this, we're right at 13%. I'm sorry, for the year to date, we're down 13%. For the last month, we're down like 9 or 10%. So it's kind of in that correction stage. Will it keep dropping? Could it go into a bear market? Are we going into a recession? All of those things are the tumultuous news, the volatility driving, uncertainty. And people want to pull out of the market. They don't like uncertainty. When it comes to the stock market, people get scared. And this is why they say that the stock market is the transfer of wealth from the impatient to the patient. People who are patient in the stock market, that is wealth being transferred from the impatient. As the market's dropping, they're selling, they're getting scared. The retail investors are selling out of their stuff. And when it starts dropping, then others will buy. And that's how, uh, wealth is transferred in the stock market. That's normal cycles that you'll see. If you watch this channel at all, you know that I encourage you, if you're investing, you should be investing long term. You're not playing the stock market, you're not gambling the stock market. You are investing for long term. And we've done some videos just recently. You can check them out on the channel, just in the search bar on the Simply Money channel, YouTube channel. Just simply type in stock market myths, and you can see some of the myths of what the stock market thoughts are, how people are fearful of it, or how misconceptions of it. There's another one on there. I forget the title of it, but it talks about the frequency of corrections, the frequency of bear markets, the frequency of these 10 to 20% corrections and these 20+% corrections. And right now, perhaps we're in a correction overall. The Dow Jones hasn't quite reached that. I don't believe the Nasdaq has reached that. S&P 500 is right on the verge. So it's not quite there yet, but it's very close. So if you've looked at your portfolio, whether you have a 401k, whether you have just a IRAs, or just investment account, doesn't matter. If you're invested in stocks, ETFs, mutual funds, anywhere, there's a high probability. And if this isn't the case, please leave a comment below and let us know what you're invested in. But there's a really strong case right now. I could almost be willing to bet that your portfolio is down. How much it's down really depends on what you're invested in. If you're invested in certain sectors heavily, like the S&P 500, you're down a little bit more. If you're invested in tech, you're probably down a little bit more. If you're invested more in consumer staples and some things, you're down, but probably not as much, because certain sectors are being hit a little bit harder or correcting a little bit more. So that's kind of where we're looking at and what's been happening. So one of the reasons I like SCHD so much is because of how they're set up. If you're not familiar with how they're set up, they have, kind of rules set in place. This is how we're setting this up. We're going to have certain companies, they have to be paying dividends, and they have to be increasing their dividends for X number of years. And they can't have cut their dividends. It has to be for consecutive years. They've cut their dividends and they drop out. And that's what we're going to be looking at here, the rules that they have. And then coming up on the third Monday of March every year, they do what they call a reconstitution. They look at I think right now there's 103 stocks in the SCHD ETF. They're going to look at all of the stocks in the ETF, and they're going to see which ones are not meeting the rules of the ETF, the way it's set up. And some will be pulled off, and then new companies that meet the ETF rule will be added. And that's what a reconstitution is. Now, quarterly, they rebalance. And what that means is, for example, that no sector can have more, and I'm going to look at the exact numbers here in a minute. We're going to share that, but no sector can have more than 20% weighting. So you can't have 30% in tech sector to help balance, when you're having these corrections, or maybe one sector is struggling. And not a single company can have more than 4%. So let's just say you have Broadcom. I don't know which one's top on there right now, but let's just say Broadcom has 4%, and it does really good for 2 months, and it gets up to 5%. Each quarter they rebalance to bring that back down, so it's no longer making up more than 4% of the portfolio stocks that are held in there. So they really keep a good tight control on, so one company doesn't take off and you get way out of balance. And if you're buying individual stocks, that's kind of what you should be doing anyways. If you set up, I'll give you an example. I have a portfolio that is set up 50/50 SCHD for my dividend growth and SCHG just for growth. SCHG is going to be more tech focused and more growth focused. SCHD is going to be more dividend and dividend growth focused. And on that one portfolio, I have it set up 50/50, that they each, say I have $100,000 in that portfolio, each one has $50,000. Now, let's say 2023, 2024, SCHG Gulf G went up because the tech stocks were really booming. They had really good couple years there. So if I didn't rebalance that, I could be at maybe, we're just not going to change the amount of money. We're not looking at the growth, just to keep this simple. I could have 60%, $60,000 in SCHG and only 40,000 in SCHD. And so now I'm out of balance. And so I want to bring that back in balance. So I would go in manually and sell a little SCHG and buy a little SCHD to keep them even. When you're buying dollar cost averaging, it should be doing that. And how I have mine set up, say SCHG is way higher when I invest on my, bi-weekly or weekly investment. If SCHD is a little lower, it'll buy a few more shares of that to try to bring it back up to equal. And it'll keep buying in that one until they're equal, and then it'll buy equally the same. So if I put $500 in, it'll put $250 in each. So that's just how the ETFs do. They rebalance quarterly, and they do a reconstitution once a year. And SCHD's reconstitution is about to happen. Now, a lot of people will say, dividend stocks or dividend growth stocks aren't all that. And I understand. If I was 20, 25, 30 years old, maybe even a little bit, older, I would probably focus more on simple growth. I still like dividend growth with SCHD because it has also a appreciation growth with it. So it's fared really well. And I want to share that with you real quick. We're going to do a share a screen here. So bear with me as I find the right form. I believe it's this one. Nope. That one. Let's go with this one. So hopefully you can see this here. So let's start with this. This is just the overview of the portfolio. I got to widen my screen so I can sheet here. So the objective of the fund is to track as closely as possible, before fees and expenses, the total return of the Dow Jones U.S. Dividend 100 Index. So here's some of the highlights. It's low cost. We've talked about that a lot on this channel. The fund can serve as part of a core complement to a diversified portfolio. So those are just some of the kind of goals that they have. You can see here, how much volume that they're doing, meaning that it's very liquid. If you have a fund that doesn't have a lot of volume, it could be hard to sell. We don't think about that with ETFs and stocks. It could be hard to sell them. That's why you don't want to have money you need immediately in the stock market, because you may not be able to sell them, or if you are selling them, you may be selling them at a major loss. So the yield right now, the 30-day yield is 3.78%, meaning if you're putting money in, you're getting paid a dividend on a quarterly basis of 3.78%. That's a pretty nice high starting yield. It's a little higher right now because there has been that dip from the volatility that's been going on. The trailing 12-month distribution, meaning if you take the last 4 dividend payments and you divide that by the share price, the percent that is yielding is 3.56. So this is higher because the latest dividend in December was and based on the current lower price, makes that a little bit higher. So that's all that is. So this is what I wanted to show you on this sheet is the performance. So as you can see here, this is SCHD, and you can see how it has done really well, outperforming, the large value shares or ETF. Sorry, and where'd it go? Sorry, this is still working on the technology of the YouTube screen sharing. Let's see. So you can see it's kept up SCHD 1 year, 5 years versus, the Dow Jones. Over 5 years, the Dow Jones got 14.76. SCHD got 14.65. So it's been doing really well. So let me exit out of that, Sharon, and let me see if I can find the other sheet for you real quick, and we'll look at that, and then we'll move on to some other things here. I believe it's one. Yeah. So let's blow this up a little bit. Zoom in. Hopefully you can see this. Close. There we go. So here we have. Where'd it go? Everything's disappearing on me. So here's your average annual return as of December of 2023. You can see over 10 years, it's had an 11% return. Over 5 years, it's been right at 14%. So compared to the S&P 500, it's lagged a little bit. But if you're a person who's looking for income, you have this 3.28% distribution that's been happening, and the growth, meaning it's each time it distributes, it's distributing more, not counting that you're investing more, you're buying more shares as you reinvest those shares. It's a great way to really drive your income. And I know overall return is going to be the same, because you got to remember, if you get let's go easy numbers, you get a 10% return on the S&P 500, and you get a 10% return on SCHD, but they're paying you a 3% dividend. You're getting 3% in dividend, meaning your growth is only 7%. So when you compare growth at 7% versus 10%, because they're paying you some. Now the difference is with like the S&P 500, your value's just going up. With the dividend, they're investing by giving you some of that profit. And if you're dripping dividend reinvestment plan, you're buying more of the same share. So it brings your value back up. You're still even, but now you have more shares. So the next time it pays dividends, it pays a higher amount. So your yield on cost over years becomes extremely powerful. And that's what I encourage people to really look into when they're looking at dividends. Make sure they're dividend growth and not just a dividend that's a high yield. Like JEPQ is 9-10%. It will pay a high dividend, but it's not growing. In fact, sometimes it goes down. So that is great for people that need income right now. I like SCHD because it's growing and it's building that yield on cost over time, which becomes really, really powerful. So that's kind of those reasons why I have that. And let me show you one more here. Try this one. So here's the holdings that you can see, your top holdings in SCHD. Let's start with AbbVie. As you can see right now, it has made up 5%, and this is as of the 13th. So, it's 5 days behind where the time of this recording. Oh no, I'm sorry. This is as of today. Sorry, my time's all messed up. So, as you can see, as of today, AbbVie holds 5%, and it's only nothing's supposed to have more than 4%. And you can see you have more than 4% on Coca-Cola, Amgen, Bristol Myers, Pfizer, Cisco Systems, Verizon, and Chevron. So when it comes time to rebalance, all of these, because they're above 4%, will have some of it sold off to bring them back down to 4%. and then some others will gain a little bit to keep, obviously the full amount of your value in there. As we go down, you can see, there's other well-known names like Texas Instruments, Lockheed Martin, and they're 3.5, 2% down here. As you get down further, this is where all ETFs do. They wean down the amount that are in there. So you have, like Best Buy, you have 0.5% of your total portfolio. So if you had $100 that you invested, you'd be buying 50 cents of Best Buy. You'd be buying 50 cents of CF Industries, where you'd be buying $5 of AbbVie and $4.73 of Coca-Cola. And so that's how, when you invest money, it's splitting it up. It's buying a little bit of all that for you, and they're automatically reevaluating all that. And you don't have to do that. You don't have to keep track of it. We'll go to the, ending here. The last one, has 0.01. So you're getting basically a penny. If you spend $100, you're getting a penny worth of this stock. And that's okay, because if this one does really good, you'll start buying more of that. So you're dollar cost averaging, and it's helping balance that for you. And let's just say, something happens and AbbVie cranks down, just dives, then, you're only dealing with 5% of your portfolio, where some companies you might be in another holding where the top company may hold 11, 12, 15%. So one company is still making up a large majority of your so that's what that is, and why that's important, the rebalancing and the reconstitution. Now, the last thing I really want to talk about is why I like SCHD, because it's in these types of markets. Yes, the return going forward may not be quite as strong as the S&P 500 or the Nasdaq, the hyper high growth, your Nvidias, your Apple, your Microsoft, they have really explosive growth sometimes, but they also have big drops. Currently, like right now, let's just use this year as an example, just a short-term window. The S&P 500 year to date has dropped about 13%, where SCHD is actually up, oh, not much, 0.11%. Nothing to write home about. You're not going to get wealthy off that. But the point is during difficult markets, during, very volatile and downward markets, it tends not to drop as hard. The floor is much higher, so you don't have those huge drops. The really good thing is, the amazing thing is, a lot of ETFs, or like people like bonds, because they're very safe. The floor is very high, but the ceiling is very, very low, meaning it's not going to go very high. Maybe you get 4% or 5%, depending on your bond. The great thing about SCHD is you don't have necessarily those 30, 40% drops like you do in the S&P 500. So your floor is really high. Um, I believe it was 2022, where everything else was dropped down 20%, 22%. Its bottom was like 7%. So the floor was really high. It had a drop, but it helps the volatility. It helps keep your portfolio a little bit more stable, along with the income, the dividend growth, and all that wonderful stuff that SCHD offers. It keeps that floor much higher, so you don't have to deal emotionally with such big drops. But the awesome part is, the ceiling isn't capped nearly like a lot of funds do. I mean, over the last, 10, 15 years, it's still brought in 12% returns. That's a really strong return on average, keeping up with the S&P 500. It's lagged, as of the beginning of this year, it lagged a little bit with the S&P 500, only because the Magnificent Seven over the last 2 years really took off. So SCHD was still climbing, but not quite as high. And so the 10-year average was lagging a little bit on the S&P 500. I'll have to look at it. I have not looked at it today. I'd be curious, if you added in this year to date, how much closer that is now, because the S&P 500 has dropped 13%, where SCHD is, like I said, only up, but it's up 0.11. So, that's closing that gap again. So you have upside possibility, really nice floor being high, so you're not quite as volatile on that. The beta, if you look at beta, if you don't understand beta, it's the S&P 500 is the benchmark, how much it moves up and down. It can go really high, it can go really low. It's a lot of volatility. The beta is just basically your volatility. So more than one is the benchmark for S&P 500. More than one beta means the market moves even more. So let's just say the S&P 500 has a 1, it has, dips of 20, 30%. It can go up 30, 40%. It's very volatile, and that's your 1. Something like Nvidia or, some other super high tech up and coming company may have a 1.2, meaning it goes even higher, but it goes even lower. So it's more volatile. The beta is higher, where SCHD's beta is around zero point 0.8, 0.85, I think it is, somewhere right in there. So it's not as volatile. And that's a nice thing when you work that in your portfolio with some other. I like, one of my favorite combinations is SCHG for growth. It has that a little bit higher beta. It goes up and down. It has great growth potential, but it also have an SCHD in there, balances that out. And when they're both growing, you have tremendous growth. When markets are down like they currently are, SCHD kind of anchors it so it doesn't drop quite as hard. Your portfolio keeps a little balance. So if you had a 10% drop and no gain, no drop with SCHD, you're really only seeing your portfolio drop 5%. So it helps balance that. And on the adverse side, if you have a 10% gain and SCHD is maybe only up 5% this year, then you only have a 7.5% gain. Again, it's a nice, to me, a nice hedge on my portfolio. And for those of you that have watched this and talked to me, the reason I like it is because of the dividend growth power and how that compounds. And so that's one last screen I want to share with you. Is I've done some videos showing this actual spreadsheet, and I'll be doing an update here in another week or so when the Q1 uh, dividend gets paid. I will update this portfolio we've done. So what I did here is you have SHD. We bought it on March 1st, 2017. This is a hypothetical portfolio. This is not my portfolio. I just use this as an example for teaching, and we put $50,000 in here, and at the time, split adjusted, it would have been $15.02. So we purchased, a little over 3,300 shares. And the reason I show this is it shows the power of the dividend growth here. We'll start with that. Let's look at the first year. You got 11 cents, 11 cents, 11, 11. So your first year, you're getting 11 cents, and your growth, your dividend yield is 3%. And so annually, you got 45 cents on the investment per share. So our first year, go back over here. Our first year off that $50,000, we made $1,500. Yeah, that's nothing to write home about, but it's a little over $100 a month, on a $50,000 investment. But because we're not living off of it, we're hypothetically using the drip, and we're reinvesting that. So we're buying more shares. And as that share price continues to climb and we're buying more shares, and just skip down here to the ending because you can watch the update in a couple weeks when I go through this more in depth. You can see as of December 2024, so 7 years later, the quarterly dividends are more than doubled now. You have 20, 27, 25, and 26 cents. Look at the payments. Your quarterly payments are almost as much as your annual were 3 or 7 years ago. And look how many more shares you've accumulated. Now we're up to 4,300 shares. You've gained 1,000 shares by reinvesting them. So not only are you getting a larger dividend per share, you have 1,000 more shares without investing another dollar of your money because it's reinvesting and buying you more shares. So it's a great way to build that. And so as you see, the dividend has grown year over year. This past year, almost 12%. So you got a 99-cent annual dividend per share versus first year, we got, 45 cents. So you've more than doubled your dividend payout per share, and you've gained 1,000 shares. And now your annual payment is I'll just say $4,200. So your $50,000 investment 7 years later is paying you $4,200 a year and continuing to grow year over year. Over those 7 years, you've earned almost $2,200 in $22,000, sorry, $22,000 in dividends. You've earned almost half of what you've invested back in dividends, and your value has grown by $71,000. So your $50,000, because you're reinvesting that, buying more shares, is up to $121,000. And this is the part that people miss a lot of times, this yield on cost, meaning based on the amount you spent, which was this $50,000, your investment is paying a dividend, which is 8.4%. So when you buy a dividend stock or ETF and it's paying 3.5%, you think, well, I could go get a CD or high yield savings and make 4%. Exactly. And then next year you're going to make 4%, and it's still going to be the same 4%. And it's not going to grow. And most likely it's going to go down because interest rates are coming down. So thus the payments that banks are going to give you are going to go down. It's safe. Yes, I get that. There's no fear at all. It's kind of that put my money in a mattress mentality. And you should have some of that. You should have an emergency fund. You should have some money to where you can ride out a really bad storm economically and not have to sell any stock or even take out your dividend when the market's really low. But that 8.4% is only growing. I forget how much it was. I just read the other day Warren Buffett's Coca-Cola, his first investment portion that he bought is paying him like 60 something percent yield on cost. I mean, can you imagine a return on investment? You put $100 in and you get $60 every year off of it because of that high yield on cost that keeps buying and growing. So that's just a wonderful thing. I'm not going to show any more on this. I'm going to update this again here in another week or so. So stay tuned for that if you really want to break down this and look at, how this works and what we've done and why we do it and how to use this to help you through the mental anguish of a downturn now. So that's where we're at in the market. It's been up and down. But SCHD is a really nice buffer. I'm not telling you to go buy SCHD, and I'm not telling you to only buy SCHD, but I would share this as educational reasons and to encourage you to look into it, to study it, to understand it. And if it fits your investment style and your investment goals, it's definitely worth looking into. It's been a great opportunity for me and for our portfolio. And right now, even though I don't like what anything's doing, it's really helping keep my portfolio from, where it could be if I was just like strictly, into S&P 500. And so it just helps diversify even more. And we can break that down more. If you have questions or about SCHD, put that in the chat, throw it in the comments, like what is it you'd like to know more about SCHD, or why I chose SCHD for a large portion of my portfolio. Those are types of questions. If you ask them, I'll be glad to do videos that just focus strictly on that. I try to share what I think most people are wanting to know about something like SCHD, but if there's a specific question or scenario, feel free to throw that in the chat, and I'll be glad to share that and create a video just for you. And I'll give you a shout out when I do it. Um, Other than that, that's all our topic tonight. I want to thank you for joining me. And if you have any questions, don't forget to hit that like and subscribe button. If you haven't, it helps our channel to grow, helps us get this information to other people. And I do appreciate you being with me tonight. And we will see you next time on Simply Money.